Welcome to the Leaders in Housing Counseling call for April 7th. We have a full house today, so very glad that so many people, so much interest in this, the topics today, and we're going to just dive right in. And we'll skip reviewing the agenda because we have a pretty crowded call today. So quickly, so Matthew, what's the latest on the federal funding update?
So this will go very quickly because there's not a lot of new information. I think this is just a refresher, but the House has still not passed a budget. It seems unlikely that they're going to pass a budget because of strong opposition from the 40 or so kind of far right Freedom Caucus. If they do not pass a budget, it makes a continuing resolution one or more the more likely outcome than them actually passing appropriations bills. They are continuing along with the appropriations process as normal. Before they went on break, one of the appropriations subcommittees marked up their appropriations bill. So we do expect that there will be an appropriations process, but as of now, it doesn't seem likely that that's going to lead to actual bills coming out. But we are, for our part, going to continue on as if it's a normal appropriations process and do everything we can to on the funding, the programs that we would like to see funded. And that is all. Okay. So we have a victory. So housing counseling data fields have been included in the universal uniform residential loan application. Oops, did I do a typo there? It's the uniform residential loan application being redesigned. We've been working on this for 3 years. Many of you have helped out in meetings and calls and things like that. And it looks like it's in and locked in. And we have a quick description. This isn't the exact wording, but this is a description of the kinds of data fields that are included. And we also have, if a home buyer signs a client authorization allowing the lender to, the servicer to notify if there's a delinquency to a counseling agency, that that got built in as well. So, making progress in this whole, one of the big programs of National Housing Resource Center from the beginning has how do we institutionalize housing counseling into the mortgage process. Well, this is a big win along that path. Having said that, we also have taken kind of a hit on an important issue to many of our clients. So we had hoped that allowing people to have the option to say what their preferred language is would be included as well. And the idea was, let's hardwire it into the mortgage process so that the lender knows what language the household would like to communicate in when they're doing the application, when critical decisions are made, at closing, and then throughout the servicing process, even if the loan is sold or the servicing rights are sold, it's always available. Clearly a critical problem in the predatory lending problems that we saw in the 2000s, and critical issue today in both servicing and originations. So despite the fact that everybody says this is a good idea, there was fierce opposition to including it into the uniform residential loan application. And we basically, while we were on a path to getting this done, the uniform residential loan application process was closed, which means they won't make any more changes. And that was a decision by FHFA, Fannie, and Freddie jointly. And we have put up fierce opposition to this. And many of you joined in on a letter that went to Mel Watt and to the CEOs of Fannie and Freddie. 126 organizations signed on in less than 4 days. And we had leading civil rights groups like the Center for, the Leadership Conference for Civil and Human Rights, the National Fair Housing Alliance, and many housing counseling groups that have been stalwarts in this work. National Capacity, which did an extra effort on this as well, were terrific. We know that this issue has gotten elevated managers,
but we are still, we still have not broken through and are working right now with congressional offices to see if they can't circulate a Dear Colleagues letter and reach out to FHFA, Fannie, and Freddie. We know that these are key issues that people in Congress completely understand why it's important. A number of offices have been very interested. So we will keep pressing on this issue, but you know, it's definitely an uphill battle at this point. We did have a very valuable meeting with the CFPB and with FHFA, Fannie Mae, and Freddie Mac, and there were two big topics here. So one of them was on borrower contact. So one of the challenges that we're having, the counseling agencies are having, is that now that there's some of the publicity is winding down around the foreclosure crisis, is reaching clients early in the process and getting them to counseling and helping, allowing people who are at risk of foreclosure. And Fannie Mae has completely understood that this is an important issue and is working closely with us and has brought in Freddie and FHFA. What we were hearing was that lenders were saying to us that they, their lawyers are telling them that they can't refer somebody who hasn't recently signed an opt-in agreement or authorization. They can't refer them to counseling and provide contact information to the counseling agency. And if we're going to build a business of doing this kind of work post-crisis, we're going to need to figure out a way that regularly people get to the counseling agencies so they can get the work done and packaged and applying for modification or whatever the solution is. And we seem to have a consensus that this is a valuable thing, and FHFA, CFPB, Fannie and Freddie are all on this is valuable. We have to make sure that there is no appearance of laws being violated, and so working out what the ground rules are. CFPB did indicate that they understood it and understood the value and the value of getting to counseling. So the conversation's really starting with all the decision makers at the table, and we're hopeful. One thing that will be helpful in the future is getting what contracts or agreements there are between counseling agencies and servicers about the relationship to provide counseling. So anywhere where you have permission to share those documents, you can share them with us. We will give them to the CFPB, and that's their first ask in this process. The second part of the conversation was really around this language preference question, and lenders and Fannie and Freddie wanted to have ground rules for how they could do this. You know, how do they handle situations where, for example, they have capacity to provide, they know what the language, if they know what the language needs of the household are, but they don't provide Swahili, what happens then? How do they manage that? Or if they have a point of contact who can speak Swahili, but not the paperwork in Swahili, or only part of the paperwork. We're going to be in a transition period, and we kind of understand that, and will not have 100% everything right away. So what are the ground rules and how to do that? And again, CFPB deeply engaged in the conversation, very interested. Fannie and us taking the lead on trying to figure out how to ask the right questions to get to solutions that are workable for everybody. And we'll keep you informed as this grows. But they're tough, nutty questions, like how do you decide what languages to start with first? And do you start with, do you say the 5 most common languages? Do you say the 10 most common languages? How does all that get done? And we will kind of hammer our way through this, but it's part of the piece that's happening, and we'll keep you informed. One notice that we put out was on land contracts, and if people were having problems getting small amount mortgages, so mortgages typically under $50,000. Now, I do understand that, you know, a $50,000 mortgage is not a very likely thing in New York City or Miami, but in parts of the country, these are much more common, and in the Midwest and parts of the South. And it's also occasionally when somebody's buying family property and things like that. There are opportunities. But this is a rising issue, and what Judith Fox has pointed out, who's kind of been in the housing field for a long time in mortgage lending. She's a professor at Notre Dame and has a law clinic in Indiana. Said, well, instead of getting these small mortgages, what people end up getting instead are land contracts. So this is where there is an agreement to, quote unquote, buy the house, but financing is supplied by the seller, and the title stays with the seller. And it's an area of wide abuse. People often pay for years and never get title to the property. They are responsible often for you know, taxes, insurance, and repairs. And in fact, they're not really an owner in the way we think about them. And so what she has asked, and this is coming up in multiple contexts, Center for CAP, the Center for American Progress, is involved in this. There's a number of other organizations that are looking at it. What they've asked is, can we identify where these, where people are having trouble, what parts of the country are people having trouble getting $50,000 loans, where they'd like to get them, and where, regardless of the amount, are we seeing land contracts. And I put out a notice. Usually you guys are like all over these things, and we can put the notice out again, requesting that the questions are here on the screen. We won't go through them, but certainly if you have any experience in this field, even if it's only one example, we're very interested in it, and very interested in seeing copies of the land contracts. A variation on this is lease to own, and you know, there can be good lease to own and bad lease to own, but it has some very similar characteristics as well. So please, if you know something about it, jump in on that as well. Okay, one last thing before we get started with the main presentation, and that's the, we've talked about this in previous meetings. We have the student loan issue has been a major one for us. We'll continue doing a lot of work on it. But in the process, it's been clear that when somebody has got a student loan and they're on one of the income-based repayment plans, and which provides for reduced payment based on their income, lenders haven't always accepted the amount of the income-based repayment plan as being the amount that is used to figure out the debt-to-income, the total debt-to-income ratio, the back-end ratio. And so we've done some looking in, and it's clear that Freddie Mac and FHA both include, only require the actual repayment amount from the income-based repayment plan. Fannie currently is at 1% of unpaid balance, but they are, we know that they're reconsidering this and may go to the actual repayment amount. It sort of makes no sense not to do anything else in these deals, especially since they're forgivable loans at different times depending on what loan product you have. But what we're still finding is that there are 2%, that lenders are requiring 2% of unpaid balance, and this must be an overlay, and we need to identify where this is happening and which lenders. We'll do a survey with the lenders, but they aren't always as candid as your clients may find out. So it'd be very helpful if you can identify which lenders you've seen where 2% of unpaid balance is used in the case of an income-driven or income-based repayment plan. So please, if we can move forward on those items, that would be great. And let me take a deep breath here, and let's move on to our main presentation. I wanted to make sure we had enough time. This is a big topic for all of us. So Lisa Rice is with us from the National Fair Housing Alliance. Hopefully many of you know Lisa. She came from our ranks and worked in Toledo in counseling and housing issues, and has deep knowledge about the work and especially the implications in fair housing. And she has been doing some work on credit scoring and how it impacts on race and ethnicity, and or as she describes here as underserved markets. Lisa, are you with us here?
Oh, sorry. I'm sorry. I have her on mute.
Okay, good.
Give me just 1 second. Lisa, we should have you, and can we just see if you have control of the slides?
Sure. It looks like
If you use the arrows to try to advance them.
I'm using the, there we go.
There you go. All right, great.
Beautiful. So welcome,
Perfect.
Lisa. We're glad you're here. Let me turn it over to you.
Thanks so much, Bruce and Matthew, for inviting me to speak to the coalition. This is a very important topic that NAFA has been addressing for a number of years. And when I say number of years, I'm talking decades. So this is a very, very long-term project. We do see that we've made advances, but we still have a long way to go, and that's not news to anyone on this call. So I do thank you for indulging me and providing me with this opportunity. And I'm going to try and breeze through the slides. Bruce does have the presentation that I'm pretty sure if you ask him, he'll send it to those of you who are on the phone. But I would ask you not to share it broader than this audience, because the bullet points are there, but there's a lot of context for the material that are in the slides, and sometimes when you give it to people without the context, they don't really understand all of the nuances of what we're trying to say and the recommendations for which we are pushing. One of the reasons that we have been tracking this issue for a long time is that we recognized when credit scoring started to be used more broadly in the mortgage origination space, the fair lending concerns that the use of credit scoring mechanisms would raise. And there are a number of reasons for this. The primary one is that the financial mainstream has never primarily serviced communities of color. Communities of color have always primarily been serviced in terms of access to credit by the financial fringe markets. It hasn't been the financial mainstream that have served these communities. And because of, for a whole litany of reasons, and I'll go through some of them in the presentation, but because of that, it is very difficult for communities of color and people who operate outside of the financial mainstream. So it doesn't matter your race or your ethnicity. If you operate outside of the financial mainstream, it is going to be extremely difficult for you, A, to either get a credit score, so you will be sort of unscorable. You'll be a part of that credit invisible community, or B, you're much likely to have a lower score. So if you are scorable, your credit score is going to be lower. There are lots of historical and current patterns of discrimination that are manifest in the data upon which the credit scoring mechanisms are based. The credit scoring mechanisms utilize data from the credit repository institutions, so think Equifax, TransUnion. They purchase data from those entities, and they use the data that they purchase from those entities in order to build the credit scoring mechanisms. The problem is that that data is reflective of credit that is dispersed in the financial mainstream. So those credit providers who operate outside of the financial mainstream really are not reporting data to the credit repositories, and the credit repositories don't capture that data. And because of that, we're seeing a lot of discriminatory outcomes. Also, there is tainted data replete throughout the financial and credit data systems because America has a bifurcated financial marketplace. That separate and unequal, that dual credit marketplace has resulted in tainted data being captured throughout the system, and it's hard to excise that tainted data out of the system. It's almost impossible to do it. There's been a long time connection between race and risk in the United States, and in fact, it's one of the reasons why our nation perpetuated a dual credit market. And that connection between race and risk has never really been eliminated from our markets. Borrowers of color are disproportionately locked out of the mortgage market and the financial mainstream, and so therefore these borrowers are much more likely to have a limited credit record. Okay, I'm trying to advance it, and let's see. There we go.
I'm not sure what's going on, but maybe I'll just advance them. I'm not sure why it stopped for you.
Thank you so much, Bruce. We do know that outdated scoring models negatively impact consumers. So for example, the Urban Institute research has revealed that there are roughly 4 million missing loans when they calculate the information from between 2009 and 2013. And those loans are largely missing because of the unscorable population and the population of people who receive lower scores because they're accessing credit outside of the financial mainstream. About 9.5 million African American and Latino consumers are not scorable using conventional models. If you look at the 2014 HMDA data, only 3.4% of GSE loans, so it's roughly 55,000 loans were made to African American borrowers. In the same year, 7.62% of the GSE loans were made to Latino borrowers. 13.1% of total purchase loans, therefore, went to African American and Latino borrowers in 2014. And we know that that is a really, really low representation. So the GSE's ability to penetrate communities of color and markets of color is really limited, and it's primarily limited because they're using such an outdated credit scoring model in their systems. Now the GSEs will say that they are not, that their automated underwriting systems do not require a FICO score, so they don't rely upon a FICO score, but the reality is that in order to deliver a loan to the GSEs, you do have to deliver it with a particular score, and it is a score that they identify. It's FICO 4. It's the fourth sort of iteration of FICO. We're now, I think, on FICO 9, so you can see how old that is. But you have to deliver it with that score in order to sell to the GSEs and be accepted sort of in their boilerplate program, because they use that score for monitoring and compliance and reporting purposes. So based on all of this information, we conservatively estimate that roughly 424,000 loans are missing in terms of loans that should have been made to borrowers of color from 2009 to 2013. And we can go to the next slide. This slide is a visual sort of depiction of America's bifurcated financial system. I'm going to go through a little bit of history to help you sort of understand how we got to this bifurcated space. But I don't think that it's any news to anyone on the phone that the United States has a long history of apartheid, and we implemented a policy of separate and unequal after the signing of the 13th Amendment, which abolished slavery in America. At the abolition of slavery, we then moved to a system of sort of de facto slavery, where we had all of these institutions that were closed off to borrowers of color. So people of color could not access banks. They were precluded from accessing, sort of the financial mainstream, and so therefore had to rely on a fringe market system to provide them with credit. So those were benevolent societies. Those were sort of shark lenders, other kinds of fringe lenders, and those lending entities morphed down through the years into payday lenders, into subprime lenders, rent-to-own shops, title lenders, finance lenders, check cashers, and the like. And those have been the lenders that have really been providing credit access to consumers of color for so many years. During the subprime lending heyday, I think this whole the whole discussion of redlining really went out of focus because there were so many loans that were being originated by subprime lenders in communities of color that people felt that redlining was over with. Okay, we no longer have redlining because there are financial institutions that are making loans in communities of color. Communities of color don't have to rely on land contracts or rent to own deals in order to purchase properties. But that really belies the issue that subprime lenders have always provided credit in this community. It's just that during the heyday of the subprime phenomenon, the subprime lenders had gotten into bed or gotten into alliance with sort of your mainstream lenders. So you might have a Wells Fargo, which we think of as a mainstream financial institution, and a consumer is going to a bricks and mortar building that says Wells Fargo on the outside, but they don't understand that when they got inside, they were actually getting a subprime loan, even though it said Wells Fargo on the door. So that blue space that you see on the right represents the mainstream market. That tan space represents the fringe market. And this is an illustration of our bifurcated U.S. financial system. And unfortunately, that tan space is the space that disproportionately services borrowers of color. Now, the challenge is when we talk about credit scoring mechanisms, is that on that blue space, the entities that operate there, they tend to report data to the credit repository systems. They also are more highly regulated. So there are balances, there's checks and balances in that blue space. And so consumers who operate in that blue space, it's a much more safe environment for them. And when they access that blue space, their information is being captured by a system that is a little bit more transparent. That blue space it tends to be more wealth building as well. Whereas the tan space is equity stripping, it is wealth debilitating, and it's much less regulated. In the past, we know it has not been. Many of these players have not been regulated at all. And consumers who operate in this space are operating in a space that is not safe. But in addition to that, the creditors in this space are not reporting data to the credit repository systems. And so if you operate in this space, how you perform with your mortgage or your debt obligations really isn't being reported to an entity. And we know that some of that, at least, well, much of it was by design, right? Because the sort of bread and butter subprime lenders like, your garden variety subprime lenders like Altegra and First Franklin and Ameriquest, they didn't want to report how well their consumers were performing because they did not want those consumers to be seen by other competitors so that they could be shopped or picked up by a competitor subprime lending provider. So it was very much by design that these entities did not report consumer data to the credit repositories agencies. Next slide. So the bifurcated system in America was institutionalized by the federal government. Many of you, I'm sure, have seen these maps before and are very familiar with the redlining maps that were developed by the Homeowners Loan Corporation and then further implemented by FHA when FHA came into existence. This is a residential security map of Cleveland, Ohio. It was created, I think, in 1939. The residential security maps are based on residential security surveys that were conducted by employees of the Homeowners Loan Corporation. What many people do not know is that the chief economist for the Homeowners Loan Corporation and then ultimately the Federal Housing Administration, a gentleman by the name of Homer Hoyt, was a eugenicist. He very much had his own personal philosophy was stemmed in a racist ideology that believed that people of color were at the lower end of the table. They were sort of on the lower echelons. And because he was a eugenicist and had these beliefs, he sort of inculcated that culture into this system that was implemented and reflected in federal policies that decided who and where people would live in America and who could get access to loans in the financial mainstream. So you'll see there the red areas are areas that are deemed to be bad areas. These are the areas where you don't want to lend. So federal dollars cannot go into these areas. The yellow areas are cautionary. The green areas are great. That's where you definitely want to be lending. And the blue areas are very good for lending as well. Now, what people, I think, don't realize, and if you go to the next slide, Bruce, I'm sorry, take us back to the residential security map. I'm sorry, this is a truncated version, so I don't have it in there, but you can go to these residential security maps and then actually look at the surveys themselves. So the surveys are the underlying data upon which the maps are developed. And I think what a lot of people don't realize is how closely synced these color-coded areas are to the racial composition of the neighborhoods at that time. So one of the primary determining factors of whether an area would be coded red or green is the racial composition, or was the racial composition of the neighborhood at that time. And we had so many policies that were perpetuated by FHA and the private market, so not just the federal government, but the private market as well, that created segregated societies. So America, if you think back to the Emancipation Proclamation and the 13th Amendment, America was not segregated. At the end of the Civil War, America was not segregated. Blacks and whites lived right next door to each other, and in many cases, of course, lived in the same home together. So America was not a segregated society. It was after slavery ended that people felt we had to separate the races, and so we got racially restricted covenants, and we got deed restrictions, and we got other kinds of policies, both at the federal level and the local level, that created segregated communities and dictated where people could live based on their race. And this map of Cleveland is a reflection of that. So if you look at the redlining map, this map was developed in 1939. Bruce, if you go to the next slide, you'll see a racial dot density based on the 2010 census. The green areas reflect where African Americans live in Cleveland. The red dots represent Asian. Orange dots represent Hispanics or Latinos. and the blue dots represent white. And you can see, if you go back and toggle forth between these two slides, you'll see it's almost a direct overlay. And if you do the same exercise for Baltimore, for Chicago, for Detroit, for Dayton, for Toledo, for Los Angeles, you do the same exercise, you'll see the same correlation. That these policies perpetuated at both the federal and state level by governments and also by the private markets, hard-baked racial residential segregation into our society, and that the basis of that residential segregation was formed or utilized as a way to determine where good lending would go and where bad lending would go. And unfortunately, because mainstream lenders did not provide lending opportunity and access to credit in communities of color, it opened up, it created this donut hole that opened up an opportunity for fringe lenders to go in and therefore provide credit to those places. And in fact, if you look at some of the historical documents from some of our older, I'm talking about subprime entities that were developed in the 1920s and the 1930s, you'll see in their developing documents, in their minutes, that they talk about the fact that they're creating this sort of fringe lending institution to specifically service the Chinese or to service African Americans or borrowers of color, because nobody else is servicing them. And the sad thing about it is that these entities that formed to provide credit in these spaces knew that they could surcharge people not based on their risk, but based on their color, because nobody else was in there trying to compete for this business. So because these subprime lenders saw an opportunity to hone in and market and really target these areas, Bruce, can you go to the next slide? You'll see a direct correlation in terms of subprime loan origination. So that this is a map that shows you from 2005 to 2006, the subprime loan originations in the Cleveland metro area. The darker the red, the higher the level of subprime lending. So those darkest red areas that you see on the map represent 65% or more in terms of subprime lending penetration. So think of a neighborhood where 65% or more of the loans were subprime, right? And you can just imagine and understand what happened to those communities. There, of course, there is a direct correlation between the number of loans that went south in those areas. So those dots, those black dots that you see, each dot represents a foreclosure in the city of Cleveland, or I'm sorry, the Cleveland metro area from 2005 to 2008. Next slide, Bruce. And so because of this issue, one of the things that we've been trying to do is to reform the way that credit mechanisms are developed and the way that lending institutions assess people's credit and look at their credit history. We're trying to open and broaden and expand that box so that people can be assessed appropriately and they don't have to be beholden to the credit scoring mechanisms that have these discriminatory outcomes. So what I'm going to do is just go through a couple of slides that show you, kind of illustrate just some of the areas where we see disparities, and then I'll open it up for Q&A if that's all right with you, Bruce.
Sounds great.
Okay, so this is a slide that shows you, this is for basically FICO 4, if you will, or older iterations of FICO, and this is how the system is sort of devised. So 35% of your FICO score is based on your payment histories, 30% is based on amounts that you owe, 15% is based on your length of credit history, 10% is new credit that you get, and 10% is the type of credit that you get. Next slide. So that largest segment, payment history. Now, given all of the information that I've discussed, you can understand why this particular measurement would have a discriminatory impact. So if you're accessing credit outside of the financial mainstream, and you understand that non-traditional credit providers don't report information to the credit repositories, that means that people who are paying their credit on time, they're not going to reap the benefit of a payment history that is positive and that could positively inure to their benefit in terms of a higher credit score. Now, what's so perverse about this thing is that if you have a loan or a credit product outside of the financial mainstream, your positive payment history is not reported, but your negative payment history can be reported. So if you go into collections, or let's say you got an AmeriQuest loan, and AmeriQuest never reported your positive mortgage payments, but you go into delinquency status or you go into a foreclosure status, that negative data is reflected in the repository system and is picked up. So the positive data, that positive payment history doesn't inure to your benefit, but the negative data is reported and reflected, picked up, and will hurt you and lower your FICO score. So what we find is that borrowers may unduly have a lower FICO score, not because they themselves are risky, but rather because the products and the services that they obtained outside of the financial mainstream were risky. Next slide. Amounts owed.
Lisa? Lisa, we just lost you. Lisa, we're not hearing you.
It looks like her phone actually dropped off. And
I'm sorry, my phone just dropped off. I'm so sorry.
That's okay. We got you back.
I hope you can hear me.
So are you speaking through the computer, or how's that working?
I'm speaking through the computer. Can you hear me?
We can hear you. It's a little harsh.
Okay. I'm going to call back in, but I'll speak through the computer until I can call back in. With amounts owed, borrowers who use payday lenders and check cashers, rent-to-own facilities, etc., are going to be negatively impacted because, again, those creditors typically do not report trade line information to the repositories, and scoring models can't pick up the fact that a consumer has credit available to them when that information is not reflected in the credit repository system. Next slide. Again, length of credit. If you are using credit with a non-traditional credit provider, you're going to be less likely to have a trade line that has a significant amount of history. So you're not going to pick up the fact that you may have had this a particular loan in the subprime space for a long time, or that you've had credit that you've accessed from a lender because that information is not reflected in the credit repository system. Next slide. Consumers who are opening new credit, so let's say that you have been accessing credit outside of the financial mainstream and you're trying to move into the financial mainstream, the fact that you're newly accessing credit is going to negatively impact your score. So borrowers who are credit invisible and borrowers who are unbanked are going to be more negatively impacted by this particular component, and we know that those borrowers are disproportionately borrowers of color. Next slide. And again, type of credit used. We know that certain types of credit that is even being reported to the credit repository system, if the system picks up that this is a finance loan or a subprime loan, the system will automatically ding the consumer. So it doesn't matter if you pay your credit on time. If you have a type of credit that is viewed to be a finance, from a finance lender, you're going to be negatively impacted because the system assumes that there has to be something wrong with you if you're accessing credit from a subprime lender or a finance lender. Next slide. And so these are the solutions, and I'm not going to go through all of them. I'm just going to go through a couple of them, and then I'm going to try and jump back on the phone, and I apologize for that. So one of the things that we're pushing is that the scope of financial data that is being fed into underwriting and credit scoring models be broadened significantly. So we are talking about using CDFI data, data from state and housing finance agencies. So we want to broaden the source from which information that is being fed into the scoring models is derived. We also want to include the use of non-traditional credit, such as rental payments and insurance payments, in credit scoring systems. And then I'll go down a little bit further because we also support and we're pushing for increased funding for housing counseling programs and educational initiatives that effectively teach consumers how to manage and access credit, because we know that we have so many consumers who were told the wrong thing by their subprime lender, and they have to be retaught about how to effectively manage and access their credit. So I'm going to stop there and open it up to questions, but I'm going to try and jump back on the line while you're teeing up the questions.
Great. Thanks so much, Lisa. And certainly if people have thoughts, comments, or questions, feel free to put them into the question box. While Lisa's transferring, I'll just tell a quick anecdote, which was years ago we did a lot of work in the group I was working with around Wells Fargo, and Wells Fargo Financial, which looks a lot like Wells Fargo Bank, but in fact was a separate corporate entity. If you walked into Wells Fargo Financial, it was owned by Wells Fargo, but if you walked into their offices, all they would offer you was a subprime loan. So regardless of what your credit was like and your financial position.
Okay, Bruce, I'm back on. I'm sorry about that.
Great. So you sound great. I'll just finish my quick anecdote here. I'm just talking about Wells Fargo Financial, which is if you went into Wells Fargo Financial, you thought you were at the bank, but in fact, all they would offer you was subprime product, and you had no opportunity, regardless of how good your credit was, and plenty of people had very good credit with subprime loans. You weren't offered that until very late in the Wells Fargo financial life.
Right, so and there were many banks who were like this, and not just, well, I'm not just trying to pick on Wells Fargo. National City was another example of that. In fact, I had a couple of clients who had loans with the Loan Zone, and they swore up and down to me that they had National City Bank loans, even though I'm showing them their loan documentation that says Loan Zone. And I'm telling them this is a subprime lender, and their loans were not even being reported to the credit repository agencies. And of course, we know that Wells Fargo and National City were both ultimately sued by DOJ for fair lending violations for steering borrowers of color who qualified for prime loans into the subprime market.
Good. So Matthew?
I mean, so I think one question as a starting point that you kind of touched on the end, but maybe we could go a little bit deeper on is, so the role that you think that housing counselors can play in helping to address this in terms of, is it just educating folks on understanding their credit score and ways to improve. Could you just maybe talk a little bit more about the role that counseling agencies can play in helping folks to improve this?
Oh, absolutely. So the first thing that I say is that counseling agencies, housing counseling agencies, and fair housing organizations need to work hand in glove. And when I ran the Toledo Fair Housing Center, it's one of the things that we sought to do. It's one of the reasons why the Toledo Fair Housing Center brought so many fair lending cases, because we had a very close partnership with the housing counseling agencies in Toledo. In fact, the Fair Housing Center had an associate, sort of a sister organization that was a counseling agency. You've got to work hand in glove. I mean, Bruce just raised a couple of fair lending issues here on the call today with you all. And housing counselors run into these issues because you're providing direct services to consumers, and if you're not recognizing it as a fair lending issue, you may not understand the full panoply of solutions that could be made available to that consumer. So the first thing I say is, if you haven't already done it, run out today and introduce yourself to the fair housing organizations in your communities, so that you all can work together on these issues. The second thing is to recognize that education alone isn't going to get it. Education alone is not going to get it. I don't care how educated a consumer is, that lender always has superior knowledge over the consumer. And that lender has more power over the consumer. And so the best thing that we can do is to empower the consumer to the best degree that we can, but then we have got to use other devices to let the consumer know that there are options available to them. I will never forget having a client who had been dealing with a subprime lender. This subprime lender was in her home, eating meals with her, going through the baby picture albums and what have you. When she came to us, Housing Counseling Agency, to get a grant, he sent her to us to get a grant, right, to get her mortgage loan. We looked at her papers and said, you're getting a subprime loan. Why are you doing this? You qualify for prime credit. And I'll never forget what she said to me. She said, Brad would never lie to me. So this lender had formed an attachment, an emotional connection to her, and was getting her to basically sell away her financial life, to write away her financial life so that he could get a huge bonus and a huge kickback. And so we finally ended up losing her because he got to her first and had formulated that emotional attachment. That's what we're up against. And so it really behooves us to reach out to consumers as early and as soon as we possibly can, to get to them, to educate them, to let them know that we're the trusted advisor and that we've got information. They can count on us. We'll be there for them. And we really have to think about it from that perspective, so that when they encounter the Brads of the world, they'll be on guard a little bit more, and maybe we can save more consumers from being, trapped into these horrible cycles.
So that really kind of dovetails well with one of the questions we have, and this might be beyond your expertise, but it's kind of a question, kind of a comment, that a lot of people of color, they say, seem kind of gun shy to get into counseling agencies because they've been so hard hit by these predatory products and practices. So the question is whether you have any thoughts on marketing to people of color to get them into counseling at that early stage that you're talking about.
Yeah, and unfortunately, for some consumers who have been hurt, marketing isn't going to do it in sort of the traditional ways that we think about marketing. You've got to connect with people one-on-one. and you've got to go to where they are. And so you've got to formulate those alliances with the community organizations that these people are already affiliated with. So you've got to be connected to the church and the faith-based institutions. You've got to be connected to the community-based organizations. It is non-traditional marketing, unfortunately. And no, I shouldn't say unfortunately. It's not unfortunate. It's a good thing for us to connect and engage with people one-on-one, because that is the way that you're going to get them to understand that you've got something great to offer them. The other thing is we have to make sure that we ourselves are diverse. So we can't be inclusive organizations with no diversity on our staff when we're going out and engaging with different populations. We have to make sure that we have staff members who speak Spanish or who are African American or who are reflective of the folks that we're servicing. We ourselves, I mean, we have to walk the walk and not just talk the talk ourselves.
Great, thank you. And I know we're short on time, and I apologize because I'm sure we're not going to get to all the questions, but maybe we'll try to do at least one more. So how can the general public impact the discriminatory practices in our community to change scoring practices, level the playing field, remove unfair black box practices, and who ultimately has control in changing how scores are arrived at?
That's a great question. So I'll take the last part, who ultimately has control. FAFA has a lot of control. Fannie Mae and Freddie Mac have a lot of control. If FAFA and Fannie opened up the box right now today, that would change the whole game plan, right? And that's, Bruce, you and I have been working together for years on this issue, trying to move FAFA and Fannie and Freddie in the right direction. And I think they're moving. They're just moving very, very slowly. So we as a community, we have to continue to push, because they're not going to do it unless we push. So we all collectively have to push. The other part of the question was, what can the public do? And I think what the public can do is to stay aware and to be aware of these practices, and to answer the call when we put it out there. Bruce, at the beginning of this webinar, you put out a call. You said, hey, you know, if you've got consumers who can't get a loan under $50,000, if you've got consumers who are being pushed into land contracts, let us know. And part of our responsibility in terms of, you know, when I say us, I mean the public, is to answer that call. Because you never know, the one consumer that folks on the call may put us in touch with could be that one consumer that gives us the lawsuit that we can bring to change everything. So answering that call, getting engaged, and being involved is extremely critically important.
That's great, Lisa. Thank you so much. This is a powerful presentation, and you know, makes us all think a lot more about this work. We are out of time here. Really appreciate the good work you're doing, and let's keep talking about these issues and thinking about ways that housing counseling as a community is a pretty powerful advocacy tool. I think that's one we should try to think of how we might be helpful there, and certainly this making sure that we're working well with local fair housing programs, and they do have these testing regimes which have helped expose deep patterns of discrimination in products and in programs, elevating issues through our ranks and through other organizations. Those are all very, very important. So, nice work.
Thanks so much, Bruce.
That presentation.
Thank you. And I might add that we're doing an investigation right now on minimum loan amounts. So I'm really hoping that the people on the call get back with you with that information.
Good, good. Well, yeah, we definitely can information share. So that's very helpful. Very quickly, as we're closing out, just that think about becoming a member of the National Housing Resource Center. We have expanded our membership benefits, and so it's a very cool one, which seems to be quite valuable. We've added to the list, which is directors and officers insurance. And this is an important kind of insurance coverage. Occasionally, no matter, as I said in the email, no matter how good the work is that you do, organizations do get sued. And this protects your board and your officers against personal liability. So you should have this coverage. It's for some organizations quite expensive, and through our relationship with the National Center for Responsive Philanthropy, we have a discount with Hancock, which is a major high-quality insurance company. And my understanding is that the savings for the groups that have looked into this have been substantial. If you're a member, you should have received the application this week in an email from me, but I'm happy to send it to you again if you need it. And if you're not a member, why not? Get in on the action. We want you in. All right, everybody, let's keep up the good work. We'll be back in 2 weeks. And then in next month, we'll have Jim Carr talking about his work on the on home ownership and the wealth gap and race. This Lisa's presentation was part of this series, and Jim has done some thinking in his own perspectives on this. He's obviously hugely knowledgeable in this field, and he'll promise, and it will be one of the early groups to actually even hear the presentation. He's been working on it for the last few months, so this will be good as well, and we'll post when that comes up. Keep up the good work, everybody. Let's stay in touch. Thanks. Bye.